life. So far, I would say there's nothing that's super concerning in terms of coming back and harming the Bitcoin network in any meaningful way. Every bear market in Bitcoin history has had some overexposed prior buyers that have to sell. Like last time we had Luna buying, Terra Luna was buying Bitcoin when things were good, and then when its whole thing was imploding, they had to forcibly sell their Bitcoin into the market. That was one example. You could certainly have that kind of thing happen again with some of these Bitcoin treasury companies, or more broadly, these other altcoin treasury companies. And that's where I actually would be concerned around more of the bubbles is in the altcoin space. But even in the Bitcoin space, it can get overdone. But Bitcoin is a proof of work network. Right now, the leverage in the treasury space is pretty manageable. And the MNAVs have already come down pretty significantly from their bubble height.
When hype takes over markets, prices can fly far beyond fundamentals. Lyn Alden points to Bitcoin treasury companies as an example. At one point, MicroStrategy traded at more than 3 times its net asset value, while MetaPlanet in Japan hit over 6 times. That kind of premium isn't about balance sheets, it's about investor euphoria. The danger, Alden explains, isn't Bitcoin itself but how people build positions around it. Excessive leverage and aggressive bidding, especially in the altcoin space, are where bubbles form. Those are the cracks that eventually lead to forced selling and company failures when markets turn. In Bitcoin's case, balance sheets are stretched in some spots, but nothing looks systemically dangerous. Like past bear markets, some firms will get washed out, yet the larger trend remains intact. A different concern often raised is quantum computing. The narrative goes that one day, powerful quantum machines could break Bitcoin's cryptography and destroy its security. Alden doesn't dismiss the risk, but she puts it into perspective. Quantum computers wouldn't instantly crack the blockchain. Instead, certain older signature types could be exposed first. And the timeline matters. There's little chance of a breakthrough big enough to threaten Bitcoin in the next 5 years. More importantly, Bitcoin is not static. The system can adapt, upgrade, and harden itself against new threats. Developers are already preparing potential defenses, ensuring the network evolves with the technology around it. For Alden, the bigger risk in the near term isn't quantum, it's human behavior in the markets. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Broader trend of could this be a bubble? The short answer is anything can be a bubble if it's overpriced or over-levered. So I certainly think that this can get overdone for periods of time, and in some areas already has. So for example, when MicroStrategy was over 3 times net asset value, that was pretty euphoric. There were other ones with like MetaPlanet was over 6 times, and I think those teams are great. I think that those teams are doing very well, but investors can sometimes overbid the asset, and then it just depends on how well that's managed. I think that the market for companies that just have another business that then add Bitcoin to the balance sheet over the long run is longer than pure plays. But I do think that pure plays, if you're the biggest, most stable one in your currency, that's generally a pretty good place to be. So that's, for example, MicroStrategy in the US or MetaPlanet in Japan. I think it makes sense for some of these pure plays to pursue that strategy because they're the leaders, they're first movers in those environments, and they're being rewarded for it over the longer term. So then you watch things like how high are their MNAVs? How high is their leverage? So far, I would say there's nothing that's super concerning in terms of coming back and harming the Bitcoin network in any meaningful way. Every bear market in Bitcoin history has had some overexposed prior buyers that have to sell. Like last time we had Luna buying, Terra Luna was buying Bitcoin when things were good, and then when its whole thing was imploding, they had to forcibly sell their Bitcoin into the market. That was one example. You could certainly have that kind of thing happen again with some of these Bitcoin treasury companies, or more broadly, these other altcoin treasury companies. And that's where I actually would be concerned around more of the bubbles is in the altcoin space. But even in the Bitcoin space, it can get overdone. But Bitcoin is a proof of work network. Right now, the leverage in the treasury space is pretty manageable. And the MNAVs have already come down pretty significantly from their bubble heights. So, while I do think that if we have this conversation years from now, I think we'll be looking back at the bear market and say, look, this company XYZ had to liquidate his coins right in the bear market, and maybe multiple of them. So there will have been some capitulation, but I think the overall trend is fine. Is how I directly talk to those who either are involved in quantum computing, those who have proposed updates to Bitcoin to further make it resilient against quantum computing, and things like that. Those that are trying to build companies that are addressing potentially some of the quantum vulnerabilities. The short answer is that Bitcoin is upgradable. It already gradually updates over time. Most of those are not consensus changes. Some of them are consensus changes, more rarely. And so with Bitcoin, the main vulnerability is not the core encryption itself. It's not as though the first time you have a quantum computer, it can just unravel the whole Bitcoin blockchain. Instead, certain signature types become increasingly vulnerable should there be a sufficiently powerful quantum computer. And so one of the first steps that people can do is, if they're in those generally very old address types, they can move them and take other practices to defend their own coins against potential security issues related to quantum computing, should it materialize faster than people think. And then two, the Bitcoin network itself does have some potential soft fork updates that can add new signature types that are more quantum resilient than even the better ones are today. Generally speaking, the downside is that they come with more block space. So in Bitcoin, there's kind of a limited amount of block space per block because it takes up bandwidth, it takes up storage. And so you generally don't want to use a bigger signature type than you have to. But should that day come, or should developers and investors get worried that it's coming soon, there are upgrade paths to protect it. So my general view is that it's not a non-issue. I have put considerable time into talking to the people that directly work on it. In their programming or in their other capacities, and I'm satisfied that the Bitcoin network has methods to circumvent it. I also don't think it'll hit in an investable time horizon of, call it, 5 years. But I do think that I am glad that there are people that are already sketching out which signature types make sense, what types of upgrade paths would be doable, and things like that. So I don't view it as a likely existential threat, but I do think it's one of the ongoing serious risks that people do have to consider.
Lyn Alden explains that if Bitcoin ever had to hard fork for quantum security, the network would split in two. Every holder would then automatically own coins on both chains. But history shows most forks don't last. They may hold value for a time, but eventually, that value drifts back to the original Bitcoin chain. The one scenario where a fork could truly succeed is if it solved a major vulnerability like quantum risk. In that case, the new chain could become the dominant Bitcoin, effectively replacing the old one. For investors, Alden says the smartest move in such situations is often the simplest. Do nothing. By holding both versions, you let the market decide which one prevails. She points to the Bitcoin versus Bitcoin Cash split as an example. Those who kept both ended up with all their Bitcoin intact, plus some Bitcoin Cash on the side. Over time, Bitcoin Cash lost relevance and value, while Bitcoin strengthened as the clear winner. Alden adds that Bitcoin's evolution isn't unlike USB or Ethernet standards. Upgrades happen, but they remain compatible with the core system. And because Bitcoin is decentralized, no single authority can push through a change. Only updates with broad, global support actually make it into the dominant chain. Let's get back to the interview.
If you have a hard fork happen, the chain would split into two. Ostensibly, one of them would be more quantum resilient than the other. And any current holder of Bitcoin would now have that number, but they'd have both coins. Now, historically, when Bitcoin has done hard forks, I mean, anyone can do a hard fork. I could do a hard fork this evening, just no one would buy it. So anyone can do hard forks, it's open source. But in Bitcoin's history, there have been a handful of serious hard forks, meaning that there's an amount of scale behind it. There are a number of large buyers, large miners, things like that support it. Historically, the hard forked coin, the one that's no longer backward compatible with the existing node network, that has historically not done well. That generally will fall in price and that value will get reabsorbed into the main chain. Now, should there be a scenario where quantum risks materialize and there's a quantum resilient hard fork, that's a possible scenario where the newer fork is the winner and becomes the new main Bitcoin. The way that users can protect themselves is if you just hold both coins, you get the benefit of whichever one wins. It reabsorbs the value of the other one. So for example, when Bitcoin and Bitcoin Cash split, if you did nothing, you still hold all the Bitcoin you had pre-split, and you'll have an equal number of Bitcoin Cash, which is worth de minimis now compared to the Bitcoin, but you haven't lost any of the Bitcoin that you had. On the other hand, there were some, say, experts at the time that had very high conviction that Bitcoin Cash was not going to win, and so they could actually sell their newly generated Bitcoin Cash and even increase their stack of Bitcoin. So someone's high conviction, they could be right or wrong, but they can sell the fork that they don't think is going to win, double down on the one that they think is going to win, so it's an opportunity. But if someone's not sure, which is probably the vast majority of people, they just can hold both just by doing nothing, and they get the benefit of whichever. When a Bitcoin Cash split, the market decides what is the true Bitcoin. And so by simply holding both, it is true that now there's 42 million coins, because you have 21 million Bitcoin, 21 million of this fork, but that fork devalues. So Bitcoin Cash is worth like 1%, for example, roundabouts of the Bitcoin network. And so it didn't really take any share other than the first several months of that contest. So there's this kind of brief period of time where there's this narrative clash, but then when the dust settles, actually I would say it was actually a strong case for Bitcoin being hard money, because you had major exchanges, major miners, all trying to forcibly change the Bitcoin network. And all they did was basically create their own copy of it that then slowly disintegrated back into the main Bitcoin chain, at least all of its functional value. And so Bitcoin as a software network can update over time, but kind of like how USB became USB 2 and became USB 3, and kind of like how Ethernet has, the Cat 6, Cat 7, Cat 8 cables that underpin network connectivity. They all update and get faster over time, but they're still backward compatible. They're still kind of their core system. That's generally how Bitcoin updates. And so it's this period of time where it does change, but it's not as though there's one central issuer of that change. It's a distributed network. And so only very high consensus changes are able to make it into the network and become the new dominant network.
Amid all the noise of speculation and fear, what becomes clear is that Bitcoin's survival has never hinged on perfection but on adaptability. Wild premiums on corporate holdings, leverage-driven bubbles, and even the distant threat of quantum machines all highlight the same truth. Outside forces may bend the market, but they have yet to break its foundation. The real strength lies in its ability to evolve, to absorb lessons from past forks and failures, and to refine itself without a central authority dictating direction. The pressing consideration now is whether investors themselves can navigate future cycles with steadier hands, or if repeated bursts of overconfidence will again create the cracks that test the network's endurance. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.